Your responses to the fourth turning videos made one thing crystal clear. You're not buying what the headlines are selling. You're skeptical of the popular opinion, the narrative that's going on out there, and you're right to be skeptical. You're right to question what's happening. The greatest transfer of wealth in modern history is happening right now, and most people are on the wrong side of it. Wealth disparity is at all-time highs, and this is all because of the wealth effect that the Federal Reserve and other central banks have been targeting all of these years. We are witnessing the same institutional behaviors right now that preceded every major monetary crisis in history, particularly in U.S. history. But this time, the scale is global and the stakes are higher than ever before. So this just is not about your portfolio performance or the value of your home or your 401k. It's about whether the wealth you spent a lifetime building will exist in recognizable form 5 years from now. We're living during a climactic time. This time is not like other times in history. So hopefully you sit up and pay attention and make some changes that we're going to talk about here. I'm Mike Preston at New Harbor Financial. Thanks for tuning in today. We've been positioning clients defensively since before these signals became obvious for quite a long time, maybe even longer than we expected. I should say definitely longer than we expected. This bubble's been going on much longer than we thought it could. Our job is not to follow the crowd. It's to see what's coming before it arrives and position assets ahead of time. There's not going to be a lot of time to react when things change in a major way. So our job is to position correctly now based on what we see. So today we're going to dive into why smart money is moving into defensive positions despite record market highs. Also, we're going to talk about what the institutional signals are telling us and why the gap between official data and reality keeps widening more so than ever. But here's why you need to stick around until the end. I'm going to share 3 specific strategies that can help you prepare for what's coming. Strategies that we've been using to position our clients to get ahead of these trends. So let's get right down to it. There's a disillusionment brewing that goes far deeper than typical market cycles. People are questioning whether the strength of the US dollar will persist. They're questioning the reliability of employment data. They're even questioning the honesty of the economic narrative that we're being fed. Some are calling it a confidence crisis, a confidence in the modern institutions. That's not surprising because that's often the part of fourth turnings, and we're living through a fourth turning right now. We think it's a rational response to the data that we're actually seeing in the real world. It's right to question the narrative. Look at what's happening beneath the surface. Large companies across tech and financing are implementing hiring freezing and stealth layoffs. And the Fed has admitted, even recently in the most recent July 30th release, that what they're really concerned about more than anything, even more than inflation, is full employment. Adding to this pressure, artificial intelligence or AI is increasingly displacing workers across multiple sectors, contributing to corporate hiring freezes as companies invest in automation and they look to save money by laying off human capital. They want to reduce human capital and drive up profitability. Every incentive in the world is aligned for them to do this, but it's not good for the public. The AI transformation is not just changing how work gets done, it's fundamentally reducing demand for human labor in ways that official unemployment statistics don't fully capture. The Conference Board projects a slowing labor market through late 2025, forecasting continued declines in job openings and hiring rates, with particular weakness in white-collar sectors like technology, finance, media. Meanwhile, McKinsey & Company predicts up to 30% of work hours in the United States could be automated by the year 2030. That's just 5 years. Accelerated by recent advances in generative AI, with millions of workers potentially needing to switch occupational categories entirely. That takes time and skills and training. Those take years to get, and they're not cheap, and they're not overnight. Goldman Sachs estimates that AI could impact 300 million jobs globally, particularly in administrative and legal fields, not necessarily leading to mass layoffs, but significantly reducing demand for new hires. All of these things are going to matter going forward. Big capital, leaders in industry, and big investors are seeing this now. Job openings are down from peak levels despite low unemployment headlines. Personal savings rates have dropped as Americans increasingly use credit cards for everyday expenses. The average household feels worse off, not better off, as the market hits all-time highs. The wealth effect hasn't touched everybody. It's touched the wealthiest the most. And there's nothing wrong with that. I'm not picking on the wealthy. I'm just saying that the system that we have has a perceived unfairness to it, where those that haven't taken the ride up feel a sort of resentment. And that's a social disconnect or a risk, in my opinion, for social conflict. Take a look at this chart. There's a chart here. This is put out by the St. Louis Fed. This happens to be the non-farm business sector labor share for all workers. This chart goes back to 1950. Take a look how during 1950 to about 2000, it was a slightly downward trajectory, but not much. And we could basically say that technology was increasing, and therefore maybe that could explain why labor was getting a little bit less for all workers. But take a look what's happened since 2000 and since the great financial crisis. Actually contracted quite a bit more than it did over the previous 50 years. The purpose of this chart is to show you that the average worker is actually getting a smaller piece of the pie as time goes on. It's not a surprise as financial engineering and money printing, quantitative easing, and these types of monetary gymnastics have gotten more and more common in recent years. Ultimately, I think the everything bubble is unfair. I think it's an unfair system, and I worry a little bit about what that does for the average person going forward. I understand that the policymakers probably argue that this needed to be done, and maybe something did need to be done after the great financial crisis, but it has been unfair, and the bigger problem is it doesn't seem to be any way out. No way out at all. No plan B. As we approach the crisis and the climax of this fourth turning, all of this within the next few years, likely. Let's hope that we don't see social conflict and other types of things like that, because the real world ramifications of these policies are significant. Employee compensation as a percentage of GDP. This one goes back to 1987, so only about 30 years. But employee compensation as a percentage of total gross domestic product has gone from 56 or 57% down to 53. Doesn't seem like a lot, but it is a downward trajectory. So these data shows that the average worker isn't really feeling the wealth effect. One could argue that they have seen that difference picked up in their 401k balances and the values of their homes, but that's only if those gains are persistent. We think the stock market will fall quite a bit, and the housing market should fall maybe less so than the stock market, but still those wealth effects, if they're not permanent, they don't really make up for a continued lower piece of the pie. Take a look at this chart. It shows revolving consumer credit owned and securitized. We can see this shooting up over the last bunch of years, particularly after the great financial crisis. This isn't good. The average person is spending more in consumer credit just to keep up their way of life. And also, if you take a look at this chart, you can see that job openings rise and hires slip in the last couple months. Basically, it's showing that there's a weakening in the job market. And the Fed is watching this closely. And here's one key tell that big money knows what's going on. Big money knows that the foundation is shaky. Real assets are surging together. Bitcoin is surging. Other cryptos are surging. Gold and silver are surging. Other metals and commodities are surging. There's a flow, a real flow of capital into real assets. That's not speculation. That is real. And it's real money. Big money is searching for stores of value that can be trusted and that are durable. That is what we're seeing, and we think the world is moving in that direction. As well, other real assets like collectibles have also appreciated rapidly. Anything that's real, and we think that will probably continue over the next decade or more. This chart here shows gold and Bitcoin have both gone up quite a bit year to date. It's only a short-term time period, but we see nothing really that should stop real assets, gold and Bitcoin, from being in an uptrend. The next chart shows collectibles. Take a look at collectibles here. This is not only historical data going back to 2018, but this is forward projected data. The collectibles market has been increasing steadily and will continue to do so probably in the future, particularly once it becomes clear that our economic system is flawed and the money printing experiment is ending. Art, collectibles, antiques, collectible wines, all of that stuff. The big money in this country has had a disproportionate benefit from the wealth targeting, from the wealth effect. They're looking for real places to put their money. Second homes, third homes, collectibles, anywhere that they can. This is not irrational fear. All of this money flowing into these real things. This is pattern recognition. These folks are seeing something real and they're acting on it. We're not just feeling this shift emotionally. We're seeing it in institutional behavior that speaks louder than any statistics. Central banks worldwide are stockpiling gold at rates we haven't seen since the 1970s. China, Turkey, and Singapore have all been rapidly increasing their reserves. They're actively reducing reliance on the US dollar and preparing for monetary instability. Other BRICS nations are doing the same. They met just last year in South Africa. They're meeting again imminently, if not now. Every year they meet and they're talking about alternative payment systems. These alternative payment systems are not going to replace the dollar and the euro dollar system overnight, but it is a headwind for those systems over the next bunch of years. These countries see the writing on the wall and they're buying gold. They're big net buyers of gold. And meanwhile, Warren Buffett's Berkshire Hathaway is sitting on the largest cash pile they've ever had. Right now, they're at about 180 billion as of mid-2025. The Oracle of Omaha has trimmed equity exposure for quite a few years, and they're not buying anything big. When Warren Buffett gets cautious, smart money pays attention. And I got to give him credit. They've actually been sitting in this cash pile for quite a few years. And so the patience that he's showing here is quite remarkable, because nobody can call a top in the market. I can say that for sure with experience. And this particular bubble has gone on much longer than I thought it could, and probably much longer than most people thought it could. And here's what's telling. These assets aren't just performing well as investments, they're functioning as alternative to trust itself. When institutional money moves defensively while retail gets told everything's fine, someone isn't getting the full story. And they're right to be concerned. The dollar's purchasing power continues its relentless erosion. What cost $1 in 2000 costs $1.91 today on average. That's not inflation, that's systematic wealth transfer from savers to debtors, from citizens to institutions. Here's the top 1% of share of U.S. wealth. In 1989, it was 22%. In 2024, it's 30%. So the top 1% own about a third of all the assets. And that's a small group of people. So here's the contradiction that's eating at everybody. Yes, unemployment is low, the markets are up, S&P is at all-time highs, but does that reflect real economic strength, or are we witnessing the financial equivalent of a facade? In other words, it's fake. Consumer sentiment is trended down, particularly since COVID. We've never recovered, and it's basically bouncing along the lowest that it's been in the last couple of decades. Consider this. We have record market highs alongside record consumer anxiety. Wall Street celebrates while Main Street struggles with housing costs, food prices, job insecurity. The gap between official data and lived experience isn't just wide, it's becoming a chasm. This isn't about pessimism versus optimism. It's about recognizing that when institutional money starts behaving defensively, while retail investors get told everything is okay, someone's not getting the full story. And it's usually not the institutions that are in the dark. It's usually the public that's in the dark. So what can you do when the system feels incredibly unstable? You don't panic, you prepare. You return to the fundamentals that have preserved wealth through every crisis in human history. Sound money means owning real, scarce, and enduring assets. Not promises to pay, but things that hold value independent of any institution's credibility. Sound investing means strategy over speculation, building positions that can weather uncertainty rather than chasing today's momentum. The first strategy, own real assets. It should come no surprise to people that watch this show, this program that we have, this channel. Real assets are king. Gold, silver, physical property, income property, and even small businesses, all are great places to have your money. Now, I'm not saying everyone can just go out there and start a business right now. If you can, great, I would encourage you. But if you already have that business, it's a good thing to have. Income property, huge bubble in income property. Again, I wouldn't go out on a limb or in debt to buy this income property, but if you own it, that's a real asset. And gold and silver for the masses, people that don't own property or businesses. Just about anyone could buy gold or silver pretty easily. Talk to us if you'd like to figure out how to do it and you haven't done it yet. So own real assets in general, that whole category makes a lot of sense here. The problem is a lot of these real assets have been bid up to ridiculous prices. So choose them carefully. Don't chase overextended or overpriced real estate in a bidding war. Don't buy luxury vacation homes, in my opinion. You're better off buying low-end or to middle range rent properties, multi-unit properties that cash flow and that have decent cap rates, that type of thing. And it doesn't hurt to just sit on cash if you're not sure what to do yet until there's a better opportunity. Second thing that you can do, don't be a sitting duck. Reduce risk and do it now, because most people are not going to do it later. This market is priced to achieve negative returns over the next 10 to 15 years. We're priced probably 3 times what the market should be priced at for decent returns. That means we could see a 2/3 loss just to get back to equilibrium. So just reduce risk. Many people are 80 to 100% in stocks. Get yourself down below 50 at least. We recommend 30% stocks. Bonds have been hit really hard and interest rates have gone up, so they offer a better opportunity. So consider getting yourself down to 30, 40% stocks in your 401k, retirement plans, if you're passively invested. The rest can go into some kind of guaranteed investments, treasury bills, etc. Or you could even go 100% to treasury bills if you're just not sure what to do. The bottom line is do something to reduce risk because you won't necessarily be able to do it later, either physically or mentally. Mentally, it's really hard to make changes on the way down. I'm not saying the market's going to top imminently, but I do think the market's going to top sometime this year, perhaps later this year. And so start getting more defensive now because it won't be easy to do it later. And if you're fully invested, you can't get more invested on the way down. And so if you do what I say, you're going to have the ability to get more aggressive later. Third strategy, pay off debt. If you have the ability to pay off debt, and if you have any interest rates that are above maybe 5%, absolutely consider paying those down. Even if your rates are in the 3s or 4s on your mortgage, you may still want to pay that down, particularly if you don't get a tax deduction for that mortgage interest. A lot of people get no benefit anymore for that mortgage interest deduction because of the tax cuts that happened quite a while back and increased standardized deductions up to close to $30,000 for a married couple. So pay off debt across the board. A debt-free existence makes you much less susceptible to all kinds of things. Less susceptible to a job loss, less susceptible to a crashing real estate market, less susceptible to all kinds of things. So pay off debt. Fourth thing, focus on your skills. The skills are the most important thing that most of us will ever have. And it's been said, and I believe this to be a fact, that the best way to make money in this lifetime is to acquire specialized skills and then get paid a lot for those skills if you can. Now, this is not an overnight process, but if you've got the ability to do so, continue to find unique skills that are rare. And no matter what that means for you, if you can continue to hone those skills, you're going to be better off. You're going to be less likely to be laid off. You're going to be more employable in the future, and you're going to make more money now. So I know that some of these themes are constant themes throughout our videos. That doesn't make them unlikely to work. That doesn't make them less applicable to what we're talking about here today. If you could do these things, you're going to be more resilient in the future. All of this is not about fear-based decisions. It's about clarity-based preparation. At New Harbor Financial, we're not trying to time the collapse or predict the exact moment that things shift. We do know it's coming. Can't guarantee it, but almost certainly climax of the fourth turning is sometime within the next 5 years. Historically, that means that stock markets will be a lot lower. We know the stock market is nearly triple what it has been on a long-term historical norm. So it isn't a huge leap of faith to say that something big and negative is coming. So here, that's why we're building portfolios that can thrive, whether or not the current system continues or fundamentally changes. We think it's going to fundamentally change. We were trying to navigate it, and we're trying not to take much of a ride down when all of this shifts. It's a crazy time we're living through here. Central banks have played so many games with fiat money, we don't know what to believe. But we're going to do our best continually to navigate that and help you through it. And so here is what we know for certain. Those that do navigate these uncertain, turbulent times successfully are not the ones that ignore the warning signs. They pay attention. They see what's going on. They're the ones that take these signs seriously and they do something about it and prepare mentally. Another thing that you can do is prepare mentally, because just knowing where we are in this story, knowing that we're in a fourth turning and that a lot of things are going to change in the coming years will help you get through it. Prepare yourself mentally that you know that this is coming. So in conclusion, I guess I'd just like to say that the economic landscape is changing and the changes are accelerating, happening faster and faster and faster. The question isn't whether you should be concerned, it's whether you're prepared for what comes next. If our analysis resonates with what you're seeing and what you're feeling, let's talk about how to position your wealth for whatever comes next. Speaking of alternative assets and stores of value, I've been getting a lot of questions about Bitcoin lately, and I'm considering doing a deep dive video into it. If you're interested in learning more about cryptocurrency's role in today's market, please drop your specific questions in the comments below. For instance, what aspects of crypto are you most curious about? Your questions will help me create content that actually addresses what you want to know. Don't forget to subscribe to New Harbor's YouTube channel. Don't forget to like this video. Don't forget to click the bell icon and get notifications. Don't forget to tell your friends about this. And lastly, please leave your comments and suggestions below. We read every one of them. And we appreciate you tuning in. And we're here in this together, and we'll help you through it. Thanks for watching.